Have you ever wondered how the world's currencies are traded and what truly drives their values? Welcome to an in-depth exploration of Forex trading, a dynamic and often misunderstood global market. In this session, we'll peel back the layers to reveal what Forex truly is, how it operates, and why it has captured the attention of millions worldwide. Whether you're a seasoned investor or completely new to financial markets, our aim is to provide a comprehensive and clear understanding of this fascinating realm. Its core, Forex, or foreign exchange, is simply the process of converting one currency into another. It's the largest and most liquid financial market in the world, with an astonishing daily trading volume that regularly exceeds $7 trillion. To put that into perspective, it's significantly larger than the stock markets combined. This immense liquidity means that transactions can occur almost instantaneously, and there's rarely a shortage of buyers or sellers. Unlike stock markets, Forex doesn't have a centralized exchange. Instead, it's an over-the-counter or OTC market, meaning transactions happen directly between participants, primarily through a global network of banks, financial institutions, and individual traders. So, how do people actually trade currencies? Forex trading always involves currency pairs. You're not just buying or selling a single currency. You're simultaneously buying one currency and selling another. For example, if you trade the EUR-USD pair, you're either buying euros and selling US dollars, or selling euros and buying US dollars. The first currency in the pair is called the base currency, and the second is the quote currency. The price of a currency pair tells you how much of the quote currency is needed to buy one unit of the base currency. For instance, if EUR-USD is trading at 1.0850, it means that 1 euro is worth 1.0850 US dollars. The movement of these prices, even by tiny fractions, is where the profit potential lies. What drives these currency movements? A multitude of factors, both economic and geopolitical, influence exchange rates. Key economic indicators are paramount. Interest rates set by central banks, like the Federal Reserve in the US or the European Central Bank, play a significant role. Higher interest rates can make a currency more attractive to foreign investors, increasing demand. Inflation data, GDP growth figures, unemployment rates, and trade balances all provide insights into the health of an economy and thus impact its currency's value. Beyond economics, political stability, government policies, international trade agreements, and even major global events can trigger significant shifts in currency values. Understanding and analyzing these factors is a cornerstone of successful Forex trading, often referred to as fundamental analysis. Another crucial aspect of Forex trading is technical analysis. While fundamental analysis focuses on the why behind currency movements, technical analysis concentrates on the what, the price action itself. This involves studying historical price charts and using various indicators to identify patterns, trends, and potential future price movements. Traders employ tools like moving averages, Bollinger Bands, and the Relative Strength Index RSI to predict where prices might go next. The belief is that history tends to repeat itself, and by recognizing recurring patterns, traders can make informed decisions. Many successful traders integrate both fundamental and technical analysis into their strategies, using fundamentals to identify long-term trends and technicals for precise entry and exit.